Hello and welcome to AD Finance. I'm your host, and today we are diving into a popular option strategies that can help generate income from your stock holdings, right? And that is covered call. You can scale this strategy consistently and make 5,000 plus dollar, right? If you know exactly how to play this right. Wondered how you can make your stocks work a little harder for you, even when they are just sitting in your portfolio? Well, that's exactly what a covered call strategy aims to do, right? It's a way to potentially earn extra income on your shares you already own, and it can be a fantastic tool for many investors. Now, before we jump in, right, a quick reminder, none of this is financial advice. It's for your education purpose only. Always do your own research and consult with a finance professional before making any investment decisions. So, with that out of the way, let's dive in. Okay, so what covered call is, right? Let's break that down, what it is and why you might use it and how you can implement it, right? At its core, a covered call involves selling, or you can call that as writing a call option while simultaneously owning an equivalent number of shares of the underlying stock, right? Covered here means you own that share. So if the option is exercised, you have the shares to deliver, right? You are not speculating on a stock you don't own. So that's way it's called covered call. Now to understand this more better, right? Let's quickly review what a call option is. Now a call option gives the buyer the right, but not the obligation to buy 100 shares of a stock at a specific price. That's called the strike price on or before a certain date, right? That date is called expiration date. Now, when you sell a covered call, you are taking the opposite side of that trade, right? That is the buyer side. You are going on the seller side. You are giving someone else the right to buy your shares at a predetermined price. Now, in exchange for granting this right, you receive a premium, which is essentially the income we are talking about, right? Now, there is another good way to think about it, right? Let's say you own a house, right? And when you sell someone the option to buy it from you at a set price within the next 3 months, for that privilege, they pay you a non-refundable fee. Okay. If the house price doesn't go above that set price, they won't exercise their option and you keep the fee and your house. Now, second thing is if it does go above, they might buy it from you at your agreed upon price, right? And that is the key. It is okay, so why we should use the covered call, right? That's the question. So there are a few primary reasons why investors use covered calls, and they mainly revolve around generating income and at the same time managing risk, right? So I'm gonna give you the point-wise things on why you should use a covered call. The first reason is income generation. Okay, this is the most common reason. Covered calls allow you to collect regular premiums, which can add up over time and provide a consistent cash flow, right? Especially in a flat or moderately rising market. This income can be used to reinvest, cover the expenses, or simply boost your portfolio returns. Second reason, reducing cost basis. Each premium that you receive effectively lowers the average price you paid for your shares, right? If you bought, let's say, a stock at $100, right, and you receive a $2 premium for selling a call, so your effective cost basis for those shares become 98, right? Because you received the $2 premium. This can be a great way to get paid to wait if a stock you own isn't performing very well. Third reason, right? A small downside protection. So while this is not a primary defensive strategy, the premium received does offer a small buffer against a decline in the stock price. So if a stock price drops, you still have the premium in your pocket, slightly offsetting your losses. Fourth and final one, right? And that is profit taking at a predetermined price. So if you are comfortable selling your shares at a certain price, a covered call allows you to essentially preset your exit strategy, right? If the stock hits your strike price and gets called away, you have made profit both ways. You have made profit on the stock appreciation up to that point, plus you kept the whole premium. Okay, let's talk about how covered call work, right? The mechanics of it. So let's dive into a practical example on how this works, right? Imagine that you own 100 shares of company X and you bought them at $50 per share, right? The current market price is also 50. You believe that company X might stay around $50 or move slightly above, right? But you would be comfortable selling it if it reaches $55, right? You decide to sell a covered call option with a strike price of 55, expiring, let's say, in a month. So for this, you receive a premium of, let's say, $1.50 per share, right? And contracts are also always in 100 shares. So since one option contract represents 100 shares, you are going to receive $150, right? So now, what are the scenarios, right, that can happen? So number one, the scenario A that can happen is stock price stays below 55. Okay, that's the first scenario. If company X's stock price at expiration day is, say, let's say $53, the call option you sold expires worthless. The buyer of the option has no incentive to buy your shares at 55 when they can buy them in the open market for 53, right? You keep your 100 shares of company X and you keep that $150 premium, right? You can then sell another call to generate more income. That was a scenario A. You made profit on the premium. Now, scenario B, stock price goes above 55. Now, if company X's stock price rockets to $58 by expiration, the option buyer will likely exercise their right to buy your shares at 55. Remember, they are on the other side of the trade, right? Your 100 shares will be called away from you at $55 each share. So you keep the $150 premium. So in this case, your total profit would be 55 minus 50 per share from the stock appreciation plus that $150 for the premium. So that will be total around 650 per share, right? That's 650 overall. So you have made a good profit from both the stock appreciation as well as the premium. So let me show you a very quick example in Robinhood platform, right, on how to execute it. Now the steps would be mostly similar in any other platform that you use. Whatever concept I explained you, that's gonna be pretty much same. But I mostly go with the Robinhood platform. It's very easy to execute. So I'm gonna show it to you in Robinhood platform. Okay. So I'm in my Robinhood platform, right? And I'm just taking Robinhood itself as an example. So when you are in the options chain, what you need to do is, let's say you think right now it's around $127, right? And you think that it might go to $130. Okay. So what you do is you do select sell and then you select call here, right? Because you are, remember, you are doing a covered call. Yeah, for the expiration, it's always good to go like 30 to 45 days out. So let's say I'm gonna go 30 days. Okay. And for this one, we are assuming that you own 100 shares of Robinhood stock, let's say at $125, right? You have that average price. So in this case, let's say we select $130 as the strike price to sell covered call for October 24th expiry. Okay. So for this one, you're gonna get credited 705, which is multiplied by 100. Remember, always multiply that by 100. So you're gonna receive $700 as premium to execute this trade, right? Now, again, going back to this example that we explained, there could be only two possibilities at expiration. If Robinhood crosses your strike price of 130, you will have to basically let go of your shares. Those shares are going to be called away. But remember, your average price we are assuming is 125. So you're going to make money of that difference from 125 to 130, which is $500, plus you're going to make this $700, right? So you are essentially making $1,200 profit on this trade if it goes past 130. Second scenario, let's say Robinhood goes down, right? And it closes at whatever, right? It closes anything below 130. Okay, it closes at 127. Okay, it basically doesn't do anything. In that case, your shares would be with you, but important part is you're gonna keep this premium as well, because that premium is for you to keep, because shares did not touch your strike price. So those are the only two things that can happen, and both scenarios, as you can see, you are going to be profitable in both cases, and that's the beauty of doing a covered call. Now, while covered calls offer appealing benefits, as you saw, it's crucial to understand the risks involved, right? No investment strategy is without its downside, and covered call here are no exception. So I'm gonna list down the risks that you take when you execute a covered call. The first one, right? Capped upside potential. This is the most significant drawback of covered call. If your stock experiences a massive rally and shoots beyond, far beyond your strike price, your shares will be called away at that strike price. So you're gonna miss out on any further gains beyond that point. So for example, if you sell it at 55 and your stock goes to 70, you will still sell your shares at 55, potentially leaving $15 per share on the table. This is the opportunity cost for generating that premium. Now, second thing, right? You still bear the downside risk. This is critical point. Many people misunderstand. A covered call offers very limited downside protection. Strategy does not protect you if the stock price completely goes down, right? Your only buffer is that small premium you collected. For example, if your $50 stock drops to $30, that $150 premium you received for selling covered call barely makes a dent in your $20 per share loss that you will have, right? You are still fully exposed to a major decline in your stock value. Number three, that is inflexibility and obligation, right? So once you sell a call option, your shares are essentially on hold. You are obligated to sell them if the price hits the strike and the option is exercised. You cannot just change your mind and sell your shares on the open market without first buying back that call option you sold. So this is called closing the position, and it could result in a loss, right? Depending on where market is, especially if the stock price has risen and the option is now more expensive than when you sold it. The last one is anyway, that's true for any stock gains, that's tax implication. The income you receive isn't free money from a tax perspective. The premium is typically taxed as a short-term capital gain, which is often at a higher rate than the long-term gains. And furthermore, if your shares get called away, it is a sale of the stock which triggers a taxable event for that capital gain on the shares themselves. So that is another thing that you should keep in mind. This is true for any other capital gain from the stock that you will have. Now, so to wrap everything up, right, a covered call is an excellent strategy for investors who are neutral to slightly bullish on a stock they already own, right? It's for people who want to generate extra income from their holdings and are perfectly comfortable with selling their shares at a predetermined price, which is the strike price. It's about generating income on stocks you already own and are willing to part with that, right? You are okay to the stocks get called away. Think of it as getting paid to a set limit order to sell your stock. Now, if you believe a stock has a massive growth potential and you would be disappointed to sell it after 10% or 15% gain, then this probably isn't the right strategy for you. The risk of missing out a huge rally is real. Now, to close, as always, do your own research and understand all this in detail before you place a trade, right? This is a powerful tool, but like any other strategy, it needs to be used in the right situation. If you have found this video helpful, guys, please hit that like button and subscribe to 80 Finance. It really helps the channel grow. Let me know in the comments if you used covered call in any of the stock, what those stocks were. If you have any questions on this one or anything related to options, I have a lot of videos in my channel. They will definitely guide you. Happy investing, guys. I'll talk to you in my next video. Bye bye.